Imagine waking up, checking your retirement account, and realizing that an algorithm literally, legally forced you to buy this massive stake in Elon Musk's space company while you were
Yeah,
sleeping.
right, yeah. Or logging onto the news and finding out your state government is just, suddenly hoarding Bitcoin using your tax dollars.
It sounds totally like science fiction, but honestly, it's very much reality today.
Oh, completely. If you look at the underlying mechanics of what's happening right now, we are watching the rules of the game change in real time.
Welcome in, everyone. You are dialed into NovaStream, your 24/7 home on YouTube for live crypto markets, global financial indices, and, well, the breaking news feed that moves them the exact second they happen.
Yep, the second they hit the wire.
Wherever you're tuning in from today, a huge hello to you. I am thrilled you've got the stream running in your browser. And today, instead of focusing on just a single topic, the sheer velocity of the news cycle kind of demands we zoom out.
Yeah, there's just too much happening everywhere.
Right. So we are bringing you today's absolute highlights of the day.
And if you've been watching the Sparkline charts updating on the stream, you already know the markets are digesting this massive amount of cross-sector volatility. I mean, we're tracking real-time price action across BTC, ETH, SOL, major altcoins.
The blood pressure spiker, for sure.
Oh, absolutely. And we're seeing some incredible divergence in the S&P 500 and the NASDAQ as well.
Yeah, and as we were pulling together the headlines from, the top financial, political, and tech sources this morning, a really distinct pattern emerged. So, okay, let's unpack this.
Let's do it.
We are witnessing a day that is just entirely defined by forced structural shifts. We're talking about political forces directly impacting media monopolies, index rules totally bypassing investor choice, and state governments rewriting the fundamental supply and demand mechanics of digital assets.
It's a phenomenal theme to track, honestly, because these are not they're not isolated events, they're systemic changes. We're moving away from an environment where individual consumer or, investor choices drive the market into this new reality where massive institutional and political mechanisms are just forcing the issue.
Let's start right at that intersection of politics, optics, and mega mergers. Because today, actions stemming directly from the White House are moving global markets, like at lightning speed.
Yeah, the ripple effects are instant.
Just look at global commodities on your ticker right now. Crude oil tumbled to its lowest levels of the session today. And why? Because President Trump posted on Truth Social that he convened a Situation Room meeting to make a final determination on a deal with Iran.
Just one meeting?
One meeting, one post, and the entire global energy market instantly reprices. It's wild.
It really highlights the sheer speed at which political developments translate into financial realities. I mean, the lag time is virtually zero. And it's not just geopolitical moves either, it's domestic optics as well.
Oh, absolutely. I mean, right on the White House grounds, crews are literally building a temporary arena right now for a UFC event next month.
Which is tied to America's 250th anniversary, right?
Yeah, exactly. And TKO Group, the parent company of the UFC, has an executive on record stating they intend to, quote, fully capitalize on the stage that is the White House.
Wow.
Meanwhile, government watchdog groups are heavily criticizing the event. They're accusing the administration of turning the People's House into this corporate branding vehicle.
And we should probably pause right here to note, just for everyone watching the stream, we are reporting these developments with strict, impartial neutrality.
Yes, 100%.
We're not taking a position on the ethics of the arena or the political maneuvers. Our goal is simply to convey the news and analyze how these blurring lines between, corporate spectacle and federal power are structurally impacting business.
Right, we just follow the money.
Right.
Which actually brings us perfectly to the biggest corporate maneuver on the board today. The $110 billion Paramount, Skydance, and Warner Brothers Discovery mega merger.
Oh, yeah. That deal is massive political hot potato right now.
It really is.
Yeah.
So the Department of Justice, under the Trump administration, is looking very likely to approve this deal at the federal level. But that likelihood is mounting intense pressure on California Attorney General Rob Bonta, mostly driven by Democratic state AGs, to step in and block it.
Right.
But I had to ask, how does a state attorney general override the federal government on a corporate merger of this size? Is it like a game of multi-dimensional legal chess, where state courts are the new front line?
That's a great way to put it. What's fascinating here is the mechanism of state-level intervention itself. You see, the federal DOJ enforces federal antitrust law. But states have their own completely separate antitrust and consumer protection laws.
Oh, I see. So they can just act independently.
Precisely. If an attorney general like Rob Bonta believes a merger will hurt California consumers, say, by reducing competition or leading to massive job cuts in Hollywood, he can file a lawsuit in state or federal court seeking a preliminary injunction.
And an injunction basically freezes the whole thing, right? Like stops it in its tracks.
Yep. It legally pauses the merger until a full trial can be held. And here's the structural secret. These trials take years. But the complex financing required for a $110 billion mega merger usually expires in a matter of months.
Oh, wow. So the state doesn't even necessarily need to win the trial.
No, the delay itself is the death blow. The state acts like jurisdictional sand in the gears of the corporate financing timeline. But because states have highly limited resources compared to the federal government, they will only strike if they believe they have an absolutely ironclad case.
And the spark that might actually give them that ironclad case is all the restructuring happening over at CBS News right now.
Oh, right, the David Ellison situation.
Yeah, David Ellison of Skydance recently settled a defamation lawsuit that President Trump brought against CBS.
Oh.
A suit, by the way, most legal experts considered baseless. And following that, Ellison appointed conservative polemicist Bari Weiss to run the CBS News division.
Despite her having no television experience.
Exactly. And now you have CBS News and 60 Minutes employees openly accusing leadership of tampering with the editorial direction just to stay in the administration's good graces.
Which creates a massive regulatory vulnerability. Opponents of the merger are pointing to this exact timeline as evidence of political interference, which, gives state AGs more ammunition to argue the merger is fundamentally flawed.
And on the other side, Paramount is desperately trying to soothe the waters. They are promising 30 theatrical releases a year, just to prove they're keeping the traditional Hollywood ecosystem healthy.
Yeah, you even have Makan Delrahim, Paramount's chief legal officer, and a former Trump DOJ antitrust regulator writing directly to Bonta, just to assure him that theaters will remain an essential part of the business.
It is wild to see the front line of corporate regulation shift so aggressively to the state level.
Yeah.
It feels like if you can't win the fight in Washington, you just move the battlefield to California.
It really does. And there is recent precedent for this exact maneuver. Think back to the local TV station merger between Nexstar and Tegna.
Oh, yeah, I remember that.
The Federal Communications Commission actually signed off on it. But then Bonta and several other state AGs filed for an injunction, which was granted. The merger was completely stalled out.
Wow. So while regulators are trying to throw sand in the gears of media monopolies, there's another massive financial event happening today that is completely bypassing investor choice altogether. Let's look at the SpaceX IPO.
That is going to be huge.
It is. Elon Musk is prepping what could be the largest initial public offering in history. We're looking at an estimated valuation of over $1.75 trillion.
That number alone changes the gravity of the entire stock market. I mean, trillion with a T.
It really does.
Yeah.
But the craziest part isn't the valuation. It's the mechanism of how we are all going to end up owning it. Because of its sheer size, major index providers like the NASDAQ 100 trigger what are called fast entry rules.
Right.
Meaning passive ETFs are literally mandated to buy the stock
Yeah.
in proportion to its market size shortly after it lists.
If we connect this to the bigger picture, you have to understand why index funds do this. A massive fund like Vanguard or BlackRock sells you a product based on one core promise. We perfectly track the market.
Right.
So if SpaceX goes public and becomes one of the most valuable companies on Earth and an index fund doesn't hold it, that fund is no longer accurately representing the market. They experience what's called tracking error.
So to prevent that, the underlying index creates a rule to force immediate absorption of mega-cap stocks.
Spot on.
Man, so if you are listening to this right now and you have a standard, broadly diversified retirement account or a 401k, you are going to be exposed to SpaceX within days of its launch, regardless of your personal investment strategy.
Yep, whether you want to go to space or not.
It's like buying a sensible, safe minivan and finding out the dealer welded a highly volatile rocket booster to the roof overnight.
That is a perfect way to visualize it. Usually an IPO happens, it trades on the open market for a while, proves its liquidity, and eventually over months or years it gets added to major indices.
The seasoning period.
Yeah. But fast entry rules bypass that seasoning period completely. The algorithms governing trillions of dollars in passive funds are forced to buy simultaneously at whatever the market price is.
Which has to create intense day-one volatility, right?
Right.
Wall Street analysts are already waving warning flags about the sky-high revenue multiple the company is seeking. If every passive fund is structurally forced to buy, that could rocket the valuation even higher.
It definitely could, but there is a unique twist here for the retail side. SpaceX is actually allocating roughly 30% of its shares to ordinary retail investors via platforms like Schwab, Fidelity, Robinhood, SoFi, and E-Trade.
Which is pretty rare, isn't it?
Incredibly rare for an IPO of this magnitude. It democratizes access, sure, but it also exposes retail directly to that intense day one algorithmic volatility we were just talking about.
Right, so we've got SpaceX capturing the absolute bleeding edge of the future aerospace and orbital logistics. But back down here on Earth, the artificial intelligence wave is creating this massive divergence in the markets.
Oh, the split is so clear today.
Yeah, we are seeing a complete split between tech hardware and traditional retail apparel.
It's basically a tale of two economies right now on the indices. Old school tech is getting a massive lift, while traditional retail is facing a very harsh reality check.
Okay, let's start with the tech boom. Dell Technologies saw a stunning 30% stock rally today. Their AI server revenue saw a nearly nine-fold jump from a year earlier.
30% in one day for a legacy company like Dell is wild.
It really is. And the narrative here is all about the shift to agentic AI and the inference phase. But for those of us who aren't building data centers in our basements, what does that actually mean?
Let's break those terms down. Agentic AI refers to artificial intelligence that acts like an autonomous agent. So it doesn't just, write a poem for you. It actively executes tasks, books flights, or manages entire workflows on its own.
Okay, that sounds powerful.
It is. And to do that, the AI industry is shifting from the training phase to the inference phase. Training an AI requires massive, power-hungry clusters of GPUs like the ones NVIDIA makes to process billions of data points simultaneously. It's like reading every book in a library at the exact same time.
Okay, so that's training. What is inference?
Inference is when you actually ask that trained model a question and it has to give you an answer in real time. For that quick, sequential logic, traditional central processing units, or CPUs, are often much more efficient and cost-effective than GPUs.
I see.
Suddenly, CPUs are back in massive demand to run these localized AI agents. That's why Dell, a legacy hardware maker that specializes in CPU server racks, is seeing this incredible resurgence.
That makes so much sense.
Yeah.
And it's not just the hardware either. ServiceNow, the workflow management software company, saw its stock soar 13.6% by midday.
Which is huge for them.
Yeah, it's up almost 40% in May, putting it on pace for its best month since its IPO back in 2012. The fear of an AI software sell-off seems to be totally fading.
Fading for now, sure, but we really have to look at the institutional counter-narrative, too. Bank of America's European equity strategists are striking a very cautionary tone today.
What are they seeing?
They're looking at the boom and bust dynamics of this massive AI capital expenditure build-out, and they are maintaining a negative outlook on European equities. They're explicitly comparing this environment to the dot-com bubble.
Really? The dot-com bubble?
Yeah, where companies just overbuilt the infrastructure before the actual consumer demand fully caught up.
So you have massive optimism backed by revenue in tech, mixed with some heavy institutional caution. But then we pivot to traditional retail apparel, and the picture is just entirely different.
It's grim over there.
Gap and American Eagle saw their stock prices absolutely crushed today, down 15% and 11% respectively.
And typically, when retail takes a double-digit hit like that, the executives get on the earnings call and immediately blame macroeconomic headwinds. They point to inflation, high interest rates, supply chain bottlenecks, or, low consumer confidence.
Well, here's where it gets really interesting. They aren't blaming the macroeconomy at all. Executives from both companies explicitly stated it is not macroeconomic forces dragging them down.
Which is so rare.
I know. Gap's Old Navy brand simply misfired on women's seasonal dresses, which forced them to lower their annual sales growth forecast down to between 1 and 2%. And American Eagle cited weak demand in women's bottoms, made slightly worse by a colder than expected spring.
It is remarkably refreshing honesty. They are bluntly admitting to execution and styling missteps. They essentially got on the phone with investors and said, we just picked the wrong clothes for the season.
Yeah, they basically said, our bad.
Exactly. And the proof that the consumer is still actively spending is right there in their own earnings reports. Gap's namesake brand actually rose 10%, and American Eagle's Aerie division saw same-store sales surge 25%.
It's the ultimate irony to me. Tech companies, with all their predictive algorithms and unlimited data, will often blame mysterious macro forces the second their growth slows. But apparel executives are looking at a quarterly collapse and saying, nope, people still have money, We just designed bad dresses.
It really proves that stock picking in retail requires incredible micro-level attention.
Mm.
You aren't betting on the global economy. You're betting on whether a creative director understands what people want to wear in a cold April.
Totally. Well, speaking of normal market behavior, like consumers simply choosing not to buy a product they don't like what happens when the buyer doesn't care about the price and never plans to sell.
So it changes everything.
To answer that, we are looking at the live crypto markets because there is a massive structural earthquake happening right now.
The landscape of cryptocurrency trading is undergoing some permanent changes this weekend, both on the institutional trading side and the macro demand side.
Let's check the real-time pricing on the stream. Ripple's XRP is actually outperforming Bitcoin today. XRP is up 1.8% to $1.30, while BTC has edged down slightly by 0.2% to $73,200.
And ETH and SOL are also outpacing Bitcoin right now.
Yeah, they are. But the major story isn't the daily price action, it's what CME Group is doing. CME Group is launching 24/7 trading for its cryptocurrency futures suite on Globex.
And for those unfamiliar, Globex is the massive electronic trading platform that traditional Wall Street uses for commodities and futures.
Right.
By expanding to 24/7 trading with only a tiny 2-hour maintenance window on Saturdays, they are effectively killing the famous CME gap trade.
I know crypto traders obsess over these gaps, but what is the actual mechanical quirk causing them in the first place?
It's basically an artifact of legacy finance meeting digital assets. For years, the underlying spot market for Bitcoin never slept. It trades all weekend. But the traditional CME futures market closed on Friday afternoon.
So there's a disconnect.
Huge disconnect. The price of Bitcoin would drift over the weekend, and when futures reopened on Sunday evening on Globex, the opening price was completely different from Friday's close. That blank space on the chart is the gap.
And algorithms would literally bet on the market moving back to fill that blank space, right?
Yes. It intensified weekend of volatility because traders would build entire strategies around the assumption that the price would eventually snap back, like a rubber band, to touch that gap.
Well, say goodbye to the rubber band. Though there are 3 open gaps remaining for Bitcoin today before the new rules fully take over. One near 70,500, one near 80,000, and one below the market just under 70,000.
Traders will definitely be watching those.
Oh, for sure. Overall, though, the total market is trading relatively flat today at a $2.5 trillion global market cap. And I'm looking at the liquidation numbers on the stream. They have finally simmered down from a massive $1 billion bloodbath yesterday to about $226 million today.
That's a huge drop.
For anyone who doesn't trade on leverage, what does a massive liquidation event actually look like under the hood?
A liquidation is essentially a margin call on steroids. When traders borrow money from an exchange to amplify their bets and the market moves against them, the exchange will forcefully sell their assets to cover the debt.
Just automatically.
Automatically. And when thousands of these forced sales trigger at the exact same time, it causes a cascading price drop. So seeing those liquidations cool off to $226 million means the leverage has been temporarily flushed out of the system.
So it's a healthy reset. But while that structural trading quirk goes away, a much larger structural demand shock is forming on the horizon. We are tracking a wave of new legislation.
This is the really big news.
26 U.S. states have now introduced bills to add Bitcoin and digital assets to their state treasury reserves. They're proposing allocating anywhere from 5 to 10% of state funds. And this isn't just theory. New Hampshire, Arizona, and Texas have already signed these bills into law.
The implications for Bitcoin's available supply here are absolutely staggering. If you look at current institutional demand, spot ETFs in the U.S. already hold roughly 6.6% of Bitcoin's total mine supply.
Which is already a huge chunk.
Right. Now introduce state governments. State treasuries don't day trade. They acquire assets to hold them for decades. We often hear the term diamond handing in crypto circles, meaning refusing to sell an asset regardless of volatility, but state treasuries are the ultimate diamond hands.
Because they just lock it away?
Exactly. If multiple states start acquiring Bitcoin, that supply is effectively locked up and highly unlikely to ever return to the open market.
Which brings up the historical context. Every time a major new entity class enters this market, it depletes supply and triggers a massive rally. When corporate treasuries like MicroStrategy started buying in 2020, Bitcoin rallied 146% by the end of the year.
Yep.
And when the spot ETFs launched earlier this year in January 2024, Bitcoin climbed 57% in just 2 months.
And both of those entities are profit-driven or fee-driven. A state government is a completely different beast. Their mandate is wealth preservation for the populace, funded by tax revenue.
So I'm looking at these historical patterns. If a typical bull cycle requires a huge injection of capital to break previous peaks, does this state-level diamond handing provide the precise supply shock needed to close that gap?
This raises an important question about the fundamental mathematics of fixed supply assets. Bitcoin has a hard cap. Only 21 million will ever exist.
Right.
When you introduce a buyer who has the power of state taxation, and their goal is to acquire a mathematically scarce asset indefinitely, the only release valve for that economic pressure is price.
Because they can't just print more Bitcoin to meet the demand.
Precisely. If 5% of a major state's treasury flows into an asset with a fixed supply, the spot market has to reprice violently upward just to accommodate that sheer volume of demand.
It is the ultimate forced hand, which, actually that brings us full circle on today's thread. We started the stream talking about how the news today is entirely about shifting rules and forced compliance.
It's all connected.
It really is. You have state attorneys general using their local antitrust laws to stall massive federal media monopolies. You have index providers changing their entry rules so that algorithmic ETFs force SpaceX into your retirement fund, whether you research the company or not.
Yeah.
And you have state treasuries using tax dollars to swallow up the available Bitcoin supply to build collective reserves.
The overarching narrative is that the individual operator, the independent retail investor, or the standalone consumer is increasingly operating in a landscape heavily sculpted by massive institutional and algorithmic forces.
So what does this all mean? If passive funds dictate that we all must own space exploration tech, and state taxes dictate that citizens collectively hold a Bitcoin reserve, what does the concept of individual investing even mean anymore?
That is the big question.
Are we all just passengers on a macro financial tide? Or is there still a way to carve out your own financial independence when the algorithms and the state treasuries are moving the entire ocean?
It's a profound shift in market autonomy, and it completely redefines what it means to actually participate in the global economy.
It certainly gives you something to mull over while we watch these spark lines keep updating. Thank you so much for tuning into NovaStream today and letting us be your guides through the highlights of the day.
Always a pleasure.
We loved having you with us. The market never sleeps, and neither does the stream. We are going to keep the feed running 24/7, so keep this tab open in your browser, watch the tickers, and stay ready for the next breaking headline. We'll see you next time.